Hello, everyone. Welcome to the AAOMC sponsored webinar. I want to welcome you all. One of our goals of our academy now is start to bring in speakers who represent different aspects of our practice, perhaps marketing, perhaps social media, real estate, etc., to help us expand ourselves and our practice. Tonight, I'm so excited to have Brad Rourke with us. I met Brad when our bookkeeper in our practice, our long-term bookkeeper of over 20 years, retired. And I really thought it was going to be a very easy position for me to replace because bookkeeper is a career. I interviewed certified QuickBooks bookkeeper, and I could tell you after about 4 or 5 bookkeepers, I knew this wasn't going to work out for our practice. So I met Brad, who's part and CEO of the Williams Group, where one of their divisions, and he'll talk about this more, was accounting and bookkeeping. And Brad, if you don't mind advancing the slide, I just want to introduce you. So Brad actually consulted with me, like many of you, you see some advertising and you call them up, and Brad and I had this complimentary uh, phone call. And basically, I said, I'm not looking for an accounting firm. I'm just looking for a bookkeeper. And I was really impressed by Brad's knowledge. He's a CPA, but also his sincerity. And I've been working with the Williams Group for about 2 years now. I'm not compensated, there's no discount. I actually asked Brad to come on this webinar to help educate us because as ODs, as eye professionals, our knowledge of finance, at least in my case, is limited. So, Brad, I really want to welcome you to this webinar and thank you personally for sharing your knowledge in optometry and accounting.
Thank you. It's very kind of you, Dr. D. I appreciate that. Yeah, it's absolutely wonderful to be on this webinar or podcast. So appreciate it.
Great. And I think that the audience will sense your sincerity. So why don't we start by one slide? I just want to show the audience something personal. So I start working with the Williams Group, and the first thing they did is clean up our categories. They have a set system of categories, and that probably took us a good 6 months on our end to clean up our QuickBooks category. That's the accounting system we use. And after we got into the groove, the first quarter, in addition to our monthly statements, the Williams Group sends me something like this. This is actually my practice. I gave Brad permission to share it with you because it's very visually appealing. For me, as a practice owner, I don't like to see red. And so this is our recent statement that he sends me. It's on the cover of our quarterly statements. And I see my cost of goods is doing really good. That's the green. And I smile, my chest is out. But in the beginning, there was a lot of red in there. And they're not consulting with me. This is my own initiative where I said, why are we in the red? So I pulled my uh, business manager and we're looking at it. So human resource in our office is in the red, and we'll explain what that means. You could see we spend very little money on marketing. The occupancy seems to be great. Overhead seems to be good. And our operating income was fantastic. So our goal after seeing this is to reduce our human resource or increase our income, one or the other. So Brad, if you want to include one more slide. So with
Absolutely.
this comes these benchmarks, and that's what gave me the idea to host this webinar. Because as you can see, this Williams Group, and I'll have Brad explain the history of the Williams Group, because I only knew them as a consulting firm that I never used them, but that's what I thought they were known for. But here they're taking our percentage of cost of goods sold, our human resource, marketing, occupancy, and overhead, and comparing it to benchmarks. And I'll have Brad explain what these benchmarks are. But they really help me as a CFO of my practice. We have 4 ODs. We're a multi-million-dollar single location practice. I'm the chief financial officer, so I have to present these figures to my partners. So when they say to me, our our occupancy is high because our rent is high, I could say, listen, to the benchmarks, we're actually doing well. It's human resource. Maybe we have room for improvement. So, Brad, why don't you advance the slide? Why don't you tell us a little bit about yourself, a little bit about Williams Group, and what you're going to discuss today? I'd appreciate that.
Yeah, it'd be a pleasure. Yeah. So once again, Dr. D, thank you very much for inviting me to be on this podcast webinar. So a little history on myself and on the Williams Group. Maybe I'll start with the Williams Group first. So we're a Nebraska-based corporation. We have clients all over the country. We started in 1987 by Dr. Brad Williams. He's somewhat of a legend in the profession, if you ask me. So there was the big three: Brad Williams, Tom Bowen, and Bill Nolan. So Bill did transitions. Brad ran the company. He's very marketing oriented and just a peach of an awesome person. So I joined, so that's 87. I'll move to 2003. That's when I joined the company. And so I'm kind of just the last man standing in a sense, because I bought out the other three, those three gentlemen, which was really good too, because we do a lot of transitions work. So I have the personal experience buying out other shareholders. So that's a little bit about me. So I'm a CPA, and I do a lot of tax work. I fancy myself as a tax accountant. There's no such thing as really tax accountant, but we do a lot of tax work, and I enjoy tax policy. And I'm also an accredited business valuator, and I've been in your profession since 2000, like I say, in 2003. So I know it pretty well, just from my experience working in it. So just a few things about our Williams Group sort of pillars of what we do. So you can see on this slide here. So we started our business doing practice management consulting, and that was always our bread and butter. Practice management consulting it's a difficult business now for a number of different reasons. There's lots of competitors, buying groups are doing it, but we're still a pure consulting company in that we're not generating income from consulting through kickback, so to speak, and there's nothing wrong with doing that through the lens companies, et cetera. So that's we started with practice management consulting. And then in roughly 2010-ish, we started a full bookkeeping and accounting company. And then we added on tax. So we have 3 tax professionals, including myself. And so that's the second area. And that's where you came to us, or we came to you, Dr. D, on the accounting or bookkeeping side. So we fancy ourselves knowing how to do that pretty well. And then the third division or pillar we have is transitions work. So we do valuations, lots of valuations around the country, buy-sell partnerships and brokerage, helping practices sell their practice, doctors sell their practice. So it's really, this whole thing gives us a pretty good overview of practices around the country. So this talk is about comparing practices. So I'll just move on here. Any questions on that, Dr. D?
No. So I actually do. So when you joined the Williams Group, it was about 25 years ago, give or take. You were just a consulting firm to ODs, correct?
Pretty much, yes.
Yeah.
Yeah. I would say 80% consulting, and then we were doing some transitions work, but it was definitely a smaller portion of it. Yes.
Got it. Okay, go ahead. Let's see what you're going to talk about today.
Good. Yeah, that's great. So here's the agenda. I'm going to offer a few things of my perspective on practices from an accountant's perspective, and then we'll look at regional practice comparisons, just how different practices look around the country, what the profitability is based on the region, and then also number 3, just what practices look like based on their revenue, not the region, necessarily the region, but say a $500,000 practice, $1 million practice, a $3 million practice, and what the profitability margins are in that variant or that pool of types of practices. And then I do want to talk a little bit or just discuss contribution margins. We'll get into that once we get into it. And then for the last 4 or 5 years in your profession, everyone's talking about EBITDA. I fancy myself an expert on what that is, so we're going to define what EBITDA is. and what the killers of EBITDA are. So basically it's cash flow, but we'll talk about the specifics of that. So, and then just look at financial statements, because it's really, in my view, and that's why one of the reasons why Dr. D joined us as a client. And we're also doing some transition work for Dr. D also and Dr. Tanner, two sons, moving into ownership. But financial statements are really key, because they're a measurement tool or a comparison tool. So we'll just get into that a little bit. So let's just move on. So a few things on how I think, because you all are CEOs of your practices, a lot of you, and then I'm now a CEO of the Williams Group. So the way I look at doing business is we're trying to do good in the world, and that's what the objective is. But we can narrow that down a little bit to our own environments, like our own practices, our own families, our own community. So that's what we're all about, and that's what we're doing as people. And then you as practitioners, and as, say, the CEO of the practice, you've got this additional responsibility for your profession. It's kind of a dual role in a sense, because you have to be the CEO, you need to run the business, but then you also have your profession that you obviously need to keep up with and stay on top of, and be true to your profession and do it well and grow in it. So it's not an easy task. So kudos to all of you that are going down that path and doing both of those. But everyone's sort of CEO anyways in their life and their families, or however you want to define that or look at that. But yeah, it's one of the reasons I love being in this profession, because people want to do what's good or what's good for others around them. It's a very service-oriented profession. I don't want to dog on attorneys or something, and because lots of professions are great, but ODs have a great reputation in the community. So I'll stop on that. So just a few comments on comparisons, because we're comparing. This is what this talk is about, is comparing your practice or you. So you can look at it in a couple of different ways, like I have here. You can compare yourself or your practice. To compare your practice to another practice. Nothing wrong with doing that. And you can compare your professional acumen to someone else. But you've got so many different nuances in doing that, because different areas of the country, different types of people working for you or with you. So it is sort of difficult to do that, to compare your practice, because it's easy to say, oh, look at this practice over there, they're doing great, or they're doing terribly. Well, those are different circumstances altogether, and you don't necessarily know what's happening in those practices. But it still is good from a benchmark perspective. So we will get into some benchmarks like Dr. D had shown initially. But really, I think the best thing to do is compare yourself to yourself and your own practice, your practice yesterday or in the future. So I'm just saying here that there's kind of two angles to look at the comparison. You can look at yourself and your practice historically. Like, what mistakes am I making today? So I'm going to fix those things. Or what did my last quarter look like compared to the previous quarter, or to the previous quarter last year, or the full year? So that's looking basically retrospectively. But prospectively, looking forward, you can also have the same mindset that I'm going to fix my problems that I have today, like errors that I'm making. So get those fixed. And also, I tend to like to look at projects, and you're going to have lots of these in your practice too, because it's great. They're going to come up with ideas. Let's get a in-house lab or something, or move the scope of your practice into something else, be it dry eye or IPL, and you're all into ortho-K and myopia. Those sort of projects can take 3 months to 6 months. So I sort of look at it like that, and then longer projects over the course of a year. So in the finance world, that's how we look at stuff. It's quarters and years. So all the public companies, let's report quarterly. Let's look at our numbers quarterly. You can look at them monthly, but it's hard to change things in a month. because 21 business days goes by quickly. So just encourage everyone to compare yourself to basically to yourself for your own practice. So my third sort of overall accountant idea or thinking is, how do you measure anything? Because measuring an optometry practice is complicated. Measuring anything, as a matter of fact, is very complicated. You got a ruler at 12 inches. Okay, you get that. But you've got so many different variables in a business enterprise. So I'm only going to talk from a financial point of view. And there's different methods, of course, to measure your profession or your practice, how you're doing. You could look at Google reviews, or how you feel about how things are going, what your staff are saying, what your patients are saying. But I'm a numbers guy, so that's what we're going to talk about today, primarily on how we measure. So there's a few different ways to measure. There's GAAP from a financial point of view. No one does that, and I've never seen it done, even though I've seen those GAAP ideas, but that's generally accepted accounting principles. Those are for public companies. And then there's tax-based accounting too. But you still have cash going out the door for a number of things, or you don't have cash going out the door. For instance, if you take Section 179 or something. So both those methods are not useful, in my view, at all for measuring an optometry practice. So we like to have just pure cash basis. What's cash coming in? We'll go through some of the categories and what's all the cash going out, and then what's left over, if anything. Is it negative? Is it positive? Are you dipping into your bank account, or are you not? So I like to measure based on just cash base only. So that's that in terms of. Let me just scroll up here just a little bit here. It's easy to get lost in this thing. Where are we here? Oh yeah, here we go. Great. So the fourth thing is just on that. What I encourage everyone to do is to do budgets. And people, fair enough, tend to cringe. Like, even when I talk about budgets, when we get to the end of the year and we want to forecast for 2026, budget that out. No one's jumping up and down and saying, "Yeah, let's get after it. We want to. Yeah, I can't wait to do the budgets." So primarily the reason why people don't like it, I don't like doing it either, because it forces us to plan and plan and quantify the plans. So it's really a discipline thing that you almost have to force yourself to do. And it goes to the comparisons also, because if you've done a budget and you said, okay, these are the things I'm going to do. I might be hiring an associate. What's the impact there? Or I'm going to expand my scope of practice, or I'm going to do some renovations, whatever that plan is. And you're going to put those down in the financial plan, because you can just run it all out. This is my revenues, what I expect. These are my costs. And then these are the additional investments I'm going to do. And then what's going to happen at the end of the year or the end of the quarter? What's my net going to be? And then I can compare my actual to that. So it's a discipline that's really worth doing. We've got templates for that too that we could provide, but just getting into that. And it's got a few other things here. Different practices are in different situations. You've got startup practices, growth phase practices. And typically with the growth phase practices, when you're really investing into it, your margins typically aren't that great either at that point, because you're putting money into the practice, trying to grow it. So the profitability declines, but ultimately you're gonna reap the rewards from that. Or like I said, adding associates, forecasting that in, or when you're going to slow down, and then what's the impact on your cash flow. Lots of doctors, when they say, okay, what's going to happen or owners, if I add an associate, what happens to my cash flow? If I keep the same doctor days, or if I want to reduce my doctor days. So just forecasting that out so that there's not any surprises. So I'll stop talking about budgeting, but it's definitely useful. So those are, some just my accountant perspective on how to run a practice in a sense. So we'll get into my regional observations. So I'm saying these are observations because we don't have stats on this, even though, but like you, we see so many financial statements, we get a really good idea or feel for what's happening around the country. This is not going to be lost on you at all, but in general, the sorry. So we got the whole country here. These states here, the Midwest, basically down the middle of the country. If you divide the country right down the middle, so you got Texas, Oklahoma, Kansas, Nebraska, South Dakota, North Dakota, and the states around those, they tend to be, from a regional perspective, the most profitable. They're putting the most of the bottom line. The owners are taking out generally more than more on average than as you move out towards the coast. So I'll just sort of quantify this a little bit here so you can see the numbers. So if we take 3 practices, we're all doing $1 million. We've got a West Coast practice, say out here in LA, or Central practice, Texas, and then say East New Jersey. So all doing $1 million. So the cost structures are different. Typically, the cost of goods sold are roughly the same as you're doing similar buying, source from sources. You might have some tax differences, sales tax issues, depending, but most healthcare objects, so to speak, are not taxable. So it's pretty steady across the country. But staff, it is a big difference. So on the coast, out here in LA, it's I see some it's just hard. It's very difficult when the cost of living in certain cities and the wages are really high out of necessity to even live here, or take New York or Newark or whatever. So typically, because of the staff costs and also occupancy, those sort of go along the same lines. So occupancy on the West Coast and on the East Coast is very high. So very few practitioners out here in the LA area own their building. Almost all of them rent, and the rental costs are very high. So if you live here, we have a client that moved from the East Coast to Western Texas and is just doing extremely well. And he was out East. So in general, from an operating net perspective, and when we go through this, you're going to see these categories and like collections, cost of goods sold, staff, occupancy, overhead. And then after deducting all those, you have your operating net. So operating net is absolutely key. Dr. D, were you going to say something?
Yes, your overhead, what's included in that overhead category?
Yeah, good question. So if I jump over to the financial statements, we'll get to a little later. So overheads is this big enough to see?
Yeah, it's tight, but we could definitely see it.
Good. Yeah. So you got banking, credit card, billing, service fees, computer IT, insurance, licenses and dues, office expenses. A lot of expenses or discretionary, get buried into office expenses. And we'll talk about that a little bit later too. Postage, your software, IT, professional. So just a mixed bag. So it's everything except for occupancy, marketing, and HR in a sense.
Got it.
Yeah. Yeah.
And cost of goods.
So these are sort of the operating net margins. West, say 23%, highest in Central, and then the East Coast generally is a little more profitable, I must say, than the West Coast on average. But there's certainly exceptions. Like there's very high profitable practice in the West and in the East. But so this is just on average, broad strokes from a regional perspective. So, all right. Yeah, so we'll talk about not the region, but the size of a practice based on their revenue or their collected receipts. So an average $500,000 practice, $1 million practice, or a $3 million practice. So yeah, the smaller practices, it's just very difficult for them to be highly profitable. Like as I'll jump back and forth here. So a $500,000 practice would generate, say, $135,000 or 27% operating net. And you've got some capital expenditures, but yeah, it's just very difficult because you still have all the sort of all the positions. You still need front desk, you still need a tech, you need an optician, you need a bookkeeper, so you have all these costs, but very little or relatively little on the top line side. I will say though that say $1 million practice, and it could be anywhere. Say a solo practitioner, and some of those practices can get up to 2 million. That's pretty rare, but as low as say down to 500,000. But those practices tend to be the most profitable. If you got one owner, one practitioner, and they're doing a lot of volume. Yeah, and so those practices do quite well. Like I've seen practices, they're $700,000 or $800,000 on doing 2 million themselves as a solo practitioner. So I will comment on exiting also with relative to the practice size. So these practices are very difficult. Small practices, hard to exit because you don't have an associate to sell to. Private equity doesn't necessarily want to buy them either. They're too small. And these practices are, I'd say, moderately easy or difficult to exit because if you don't have another partner, and I'm always encouraging practitioners to bring on an associate because you've got that other person to run use cases by or cases by and just talk to them about it, and you've got a potential natural exit strategy. Yeah, these practices, $1 million practices solo practitioners can do quite well. And then larger practices, they're typically are not, you would think that because of the economies of scale, that they would be more profitable, but frankly, I don't really see it because what I see happens is you've got, say, 3 or 4 practitioners, and they all have their opinions on how to do things. And then once you get larger, also you've got more pressure on the benefits, and then it's just they're more difficult to manage. So kind of the sweet spot from just a pure profitability is that single owner and solo practice, solo location. These large practices, though, are much easier to exit. You've got way more options. You can sell to private equity. You can sell to your associates. It's just a lot easier from that perspective. So just putting some numbers on it. So operating nets on 500,000. So these are say $400,000 to $750,000 practices. Yeah, their cost structures are just higher as a percentage. So all these percentages here, they are a percentage of the collection. So in this case, 135,000 is 27% of the 500,000. So as we go down, so staff costs tend to be higher because you just need similar people. So again, the $1 million practices, those tend to be that are really profitable, high drivers, so to speak. They know how they want to practice. They get everything efficient. They've got everyone sort of lined up. Whereas in the larger practices, there's a lot more just discussion that needs to happen among the practitioners and how we're going to run things. And they can be a little bit more inefficient. So that's all I'll kind of say on these practice sizes. Just a few other scenarios, so to speak. I touched on this already. Large single, one location practices are very profitable. In this situation, you'd have one owner. So one practice owner, Dr. D, you own the whole practice, and say you've got 3 or 4 practitioners working for you as associates. Those do really, really well also because the owner knows what they want and how to drive it. Because you're not going to become a $3 or $4 million practice as a single practitioner unless you're pretty driven to get things done and want things. So you're really functioning as a CEO and doing that role really well in this scenario. So multi-locations, some people think, well, yeah, if I have several locations, and this is just from a profitability percentage perspective, multi-location practices they're not as profitable as, so if you have a $5 million practice, one location versus multi-location and doing the same 5 million, but have 3 different locations, 1 large practice and 2 satellite, they're typically not as profitable. Just because, again, at the locations, you still need front desk. You can consolidate some of the buildings, et cetera, and you can see your practice management system. You can have one fee on that, et cetera. No, but then again, in that situation, you've got additional expenses there. But so you might think, well, they are profitable. But from an exit strategy point of view, if you have multiple locations, they're fairly easy to or easier. These are easy to sell, so speak, or exit. These are reasonably easy to sell also with multi-locations. And retail first practices, they can do really well too, because if that's what your aptitude is. So if you love the retail side of it and love the aesthetics and are really acting as a CEO and you're buying, and if you have an in-house lab or a surfacing lab, you can do really well in the retail first practices also, because I've seen some very beautiful practices where their optical area is just wonderful. People love going there, and it's versus more very medical, which is just a different vibe. But of course, you can have both. So those are some categories about my observations of what I see around the country with practices. So, all right. So I want to spend a few minutes talking about this is an accounting concept, contribution margin. So I'll define it, but don't worry about it if you're not understanding it initially. We'll just kind of go through a few things, and you'll get the idea here pretty quick. Essentially, what it is, if you're going to sell anything, like for us, so we sell an appraisal. What's our cost in that appraisal? What's our direct input costs to do that? Not all the overheads, but what's it cost me to pay someone to deliver that appraisal? Or if it's a comprehensive exam, like what's your direct cost? So you have your fee, and then you got your direct cost inputs. Not all the overheads, your occupancy overheads or your equipment. Who's doing the work to actually deliver that medical service? So you got your fee, whatever that is, and then your direct cost of doing the work to provide that service. So a lot of you will know intuitively that, okay, you're making money on this, or you don't think you're making that much money on it because it's just taking you a lot of time to deliver, or you've got some high HR costs, or whatever your case may be. You kind of know it intuitively on each CPT code or fee that you're delivering, and your frames and lenses also. But it's really useful to quantify it, so you can just really nail that down. So we'll just go through that a little bit on how you can do that. So first thing you can do if you have a medical procedure is, okay, what are my costs on that? How much time? Because your time is money. You're not, people are in your practice and yourself. You're all getting paid. So you can look at say an average tech, whatever, you can plug in whatever numbers you want. Say 50 grand, a scribe 50 grand, a doctor say 107,000. So if I take a 1,900 hour a year, full year is 2,080 hours, so 1,900 includes the vacation time, et cetera. So 1,900 times 60 minutes in an hour, that's 114 minutes in the year based on 1,900 hours. So you got a cost per minute here. You say, okay, well, who cares? 44 cents, 44, and $1.49 for the doc every minute they spend. So if you look at these two, and we'll get back to that in a moment on that cost per minute, because this doesn't really tell that story, but we'll just go through this. As an accountant, I'm thinking, okay, if I have a fee, my reimbursement is 100 on CPT code A and CPT code B, and then my labor costs to get it done are $55. Excuse me. What's that? $45 gives me $55 profit margin on this particular contribution margin on that particular procedure. Or if I'm going to do this procedure and it takes a longer, that's 60 or $58 worth of costs. Then my contribution margin on that is $33 versus $55. So as an accountant, I'm saying, okay, let's do more of these. So that's basically the idea here. So I'll make it a little more concrete.
Brad, I'm just going to remind the attendees. I think you were kind enough to share these spreadsheets with the attendees, correct?
Yes, yeah, yeah.
So,
So
I was a little overwhelmed when he went through this. I break down my cost by chair cost, as many of you who've heard me speak. Brad, being a CPA, he breaks it down to the minute. And I thought that was a very interesting way of looking at it. And I pointed out some of us have scribes, many of us don't. So he was kind enough to say, okay, Nick, I'll share these spreadsheets with your attendees so they can do their own manipulation of these spreadsheets. So thank you, Brad.
yeah, good. Yeah, we'll definitely send this out. So I'm looking at the clock here, and time is ticking by here. So I'll try and roll through this reasonably quick. But
I
this is
think this is important because intuitively we really don't understand as healthcare providers. We want to give the best care. We can't speed ourselves up if we're the type that spends amount of time. And then all of a sudden at the end of the month, we're really perplexed why our salaries are compromised, especially when you accept insurance, because you can't raise your fees according to how you provide the care. We all get paid the same whether we spend 5 minutes or 25 minutes with a patient. I think this spreadsheet explains it with using facts, using numbers.
Yeah, it's useful to do this because you probably have maybe 20 very common medical procedures you're doing. So you could potentially do this for every procedure code, and there's not that many of them. So here's the fee. So we have $127 for a comprehensive exam, established patient, or say a vision plan reimbursement at 70. So I'll just look at the two differences. So this is the previous slide I was showing you about the cost per minute. So on a comprehensive exam, it takes your tech 10 minutes, put it whatever number in you want, 15, doesn't matter. But so the tech takes 10 minutes. Your scribe in the exam room takes 20 because they're in there in the exam room with you the entire time, and you take 20 minutes. So based on that, for that 10 minutes costs you $4, this costs you 9, and then 30. So your total cost on that's $42. So those are all your real direct variable costs. So you're paying that person to help get that procedure done, and you're doing it yourself. So that's your cost. So at 127 on this, I'm making $84. That's great. So at 70, I'm making actually I'll move this back to 20.
Now that $84, Brad, we still have to deduct our overhead from that, correct?
Yeah, you're deducting everything. That's right. But I mean, if you're doing 1,000 of these a year, so that's $84,000 essentially. That of profit on that particular procedure that you're applying to all your other costs, your overhead, your occupancy,
So it's not profit. I guess it's gross profit. Is that what you would call it? It's not in my pocket, that
no,
$84.
yeah. So it's the idea of looking at a particular procedure and saying, what am I making on this medical procedure versus another one? So
Got
then
it. Got it.
typically just maximize the one I'm from an accountant's point of view. And I'm not talking professionally from a doctor's perspective, just from an accountant's perspective. So yeah, in this case, if it's $70 reimbursement, same 10, 20, and 20 on the time, that's your minutes, cost you $42, same cost. So you're netting $27. So that's a big difference, 57. So you do 1,000, that's $57,000 you're not getting just based on this. Or let's just say you want to spend 45 minutes with the patient. And then you wouldn't have scribe typically then. And then you've got your tech time. So your costs on that are if you're getting reimbursed 70, and then so your total costs, including yours at averaging 170, yeah, you're losing a dollar 50 every time you do that. So managing your time on is just very important because that's what your costs are, and that's what you're selling is your time and your staff time. relative to that. So, all right. So let me talk about, we're going to talk about EBITDA killers. Again, we're 20 minutes out. So Dr. D, tell me if you think we just need to
I
skip.
think we hope to do another one of these on transitioning practices, either buying it yourself, or to someone else. But I'd like you to explain EBITDA to the patient, to the attendees rather.
Good. Yeah. So this is going to be a basic, I think this will come clear to you. So EBITDA is the acronym earnings before interest, taxes, depreciation, and amortization. So that's the acronym. Then this is quantifying it. So this is your earnings right here ultimately. So this is how to calculate the earnings. So this is why I like to have our clients' financial statements in this format: collected receipts, cost of goods sold, staff costs, occupancy, overheads. That's the operating net. 34% is pretty good. Deduct doctor compensation, reasonable doctor compensation. So that's my earnings. So it's earnings before, so you don't deduct interest, which is capital expenditure, and you don't deduct equipment loans. So that's what the depreciation is, effectively just equipments or debt service on equipment. So that's generally depreciation, because those are depreciable assets, or basically capital assets. And amortization, it's very rare in optometry practice you're amortizing goodwill unless you've sold your practice. I won't get into those details, but that's what it is. So it's just basically your money coming in, less your cost of goods sold, less your staff costs, less your rent, less your overhead. If you're renting this, if you own the building, then you got to make sure that your rent is fair market value. So if you want to increase your EBITDA by simply charging yourself lower, if someone's going to buy it, they're not going to rent a below market rent from you. They're going to pay fair market value. So the numbers matter, but that's the definition. This is your earnings right here. Essentially, that's EBITDA. Money coming in and having these things deducted, but not any of interest or any capital, any equipment, any loan payments. None of that's in it. So if we want to look at the multiple, so if I take a multiple of 7 on this 190, anywhere, peer-to-peer transactions are 3 to 4 multiple in general. I don't really like to look at the EBITDA multiples, because a lot of people calculate them differently and say, well, I got 10 times EBITDA or whatever. But, well, how are you defining your EBITDA? But on this case, multiple of 7 on 190,000, that's 1.3 million, would give a $1.3 million valuation. And for you mathies out there, so the 7 multiple is essentially just taking the reciprocal, taking 1 divided by 7, that gives 14.3. So the buyer is expecting to get 14% return when they pay you 1.3 million, and then they're going to make 190 grand every year. That's 14%, and that's what they expect. So if you go here, let me just go to EBITDA. So if I go on 8 EBITDA, that takes it down. So that means I'm going to pay more for your practice. I'm going to give you 1.5 million for it. So that's the reciprocal of that is 12.5. So really, I'm saying I'm only going to get 12.5% return when I buy your practice, because 190 on 190 grand every year on 1.5. That's after paying you, the doc, etc. So I'm going fast here, doc, because
Yeah, I think we'll touch on that next time.
we will. Yeah. Good. So we have some EBITDA killers, but maybe we'll just
Let's pass on that, and we'll talk about it next time, because I really like you to spend time, Brad, on telling us the difference between a P&L statement, a balance sheet, and why it's important to really
yeah.
have one with valid data in there. How does that help us?
Good. Yeah. So conceptually, so your balance sheet is your position in life, or a position in the world, so to speak. It's not your performance, it's what your position is now at a certain day. So what's your cash position? What's your accounts receivable position? what have you spent on your equipment? So I'll give you an example. So that's balance sheet is your position. It's not quite as important, quite frankly, in optometry practice or healthcare practice, the balance sheet, but I'll touch on that. And your P&L is basically your financial performance, and everyone knows that. But it's how is it being measured? Because like I said before, you can do GAAP, you can do tax, you can do hybrid, you can do full cash. So your P&L, in my view, is the most important by far. So let me just bounce over to this is how we present our financial statements. This is just an example. So you can see on the balance sheet, I always like to have a comparison because I want to see how much cash that I have now compared to what I had at the end of the year. So I always want to have that, and I can have the change. So that's important to me. You can see inventory is missing on the balance sheet, and so is accounts receivable because that's in your practice management system. I think it's a bit of a pain in the neck, quite frankly, to take those balances and make journal entries into your balance sheet. You can do it, but you can sort of know, you can look at your practice management system. How much AR do I have and how much inventory do I have? And even those are difficult to keep accurate. So typically we're not showing those those positions, assets on the balance sheet. But it is very useful and to have your total equipment capital expenditure that you have in your balance sheet. Because you can see, okay, it's better to have the separate furniture and then diagnostic equipment. But knowing what you've invested in the practice over the years, that's important to know what that is. So again, that's just your position. And then typically accounts payable is not done very well either. That's why I like to advocate to our clients, use your credit card, put everything in your credit card because you get the points and you know what your balance is. You can see it on the credit card. So there's no accounts payable here. And then we like to show having your debts, equipment loans or practice finance loans or what are those balances? And they're all as of this date. So that's your balance sheet. And yeah, it's hard to rely on it, quite frankly, unless you've got a very competent bookkeeper that's keeping these things in line, making sure your loans are at proper balances and your banks are reconciled, et cetera. So that's all I'll talk about in the balance sheet. So with the P&L, this is, in my view, really important to have it structured like this. And all those tables I was showing you earlier, they're just condensed versions of this. This is an expanded version. So you've got your cash coming in, collect the cash. I've seen some practices that want to take their billings from their practice management system and then book them in here. It gets really, then you've got really unclean books. You don't know where you're at. But so listing all your costs of goods sold, so that's good. And then have your staff costs all in one section. So you can see the total and what the percentage is. So here, the staff costs are 19%. So this column actually relates to this column. So knowing what your percentage is. Marketing is usually fairly low, so not a big deal. And then your occupancy costs at 6%, just having them in the sections. So you can tell you're a bookkeeper or your accountant just to take your QuickBooks and you can put them in these categories. You don't need to have that long laundry list of stuff and just say alphabetical. It's just put them in these categories so you can see what they are. Then your overheads. And then you, in my view, this is an absolute must. You need to know what your operating income is. So that's by definition, my definition or general definition. Money coming in, again, less your cost of goods sold, minus your HR, minus your occupancy, minus your overhead. So that's how much on every dollar that comes in before I pay doctors, what am I making? So in this case, it's 38 cents on the dollar, pretty high operating net. Dr. D, yours is 42, so it's pretty good. So knowing what that is, you can kind of ignore the other income. But then after that, these other categories are very important also. What are you paying your associate doctors? And then your capital costs, so medical purchases, and then your loans. This is all capital, basically CapEx, because you're paying loan payments against equipment or whatever it is. So those are really important. And then this really, your non-operating costs. it's really important to keep this area up here clean. So before your operating net. So if you're doing any discretionary expenses, any travel or going to Costco and taking half of it at home, whatever, yeah, just put all those in your non-operating costs, automobile, entertainment, meals, etc. Because in my view, you need to know what your operating net is. For instance, if your operating net is say 25% and you're paying a doctor 23% of their production, then that gap is only 2%. You just need to know what that is. So just keeping the doctor costs and any personal stuff down here. And then the owner costs. So a lot of docs, just knowing, I'm going to pop over here real quick to the owner compensation. So in this section here about the owner doctor earnings and tax installments, just make sure it's all in. So your wages, your FICA, all your benefits, all your distributions, any tax payments that the practice is making on your behalf, all your discretionary costs, so that you really know, okay, how much money am I really taking out of my practice? Because we can be easily blind to that. Oh, I'm only making 100 grand. Well, actually, no, this is all coming up to your benefit also. And then if you're also paying your practice finance loan down, that's really all money that's kind of going out to you. So, yeah, so the structure of your P&Ls is, yeah, it's imperative to know, so you can see what your operating net is, how much you're paying your associates, how much you're taking out yourself, what are you spending on capital expenditure. So basically those big three. So you got the big four up here. So these are the main sections you want to have. So the big four: cost of goods sold, money coming in, cost of goods sold is 1, HR is 2, staff HR, occupancy is 3, and overhead's 4. Though you can put marketing under overhead, so make sure you have those 4 sections. That's going to give you your operating income. Then down here, we got more sections, doesn't matter, but associate doctor section. So below operating expenses, you need 3. Associate doctor expenses, capital expenditures, that loan payments, debts, anything for the equipment, and then owner doctor. So, and then that's going to give you what's left over, if anything, in this case, 35. So, yeah, because so it's very hard to read financial statements unless they're done properly. Because if you get a laundry list or it's not compared to last year, you really need to know what you're looking at. So I'm a bookkeeper. I'm proud to be a bookkeeper, and so having a good bookkeeper is, yeah, in my view, worth their weight in gold, so to speak. I covered this. Yeah, these are the must-haves. I just talked about those costs. These big 4, and then these big 3 after your operating net, and then what's left over, if anything. So that's a cash-based P&L. So don't let your accountant or your tax accountant or anyone tell you, well, I can't have it in this format. They can, because on the tax return, it's called M1. So you want your numbers presented to you as the CEO in this format, and no excuses about it. Just tell your accountant that that's how you want it, because they can make the adjustments on the tax return. If something's not deductible, say your distributions are not deductible, they can adjust that on the tax return. So I'm talking fast here because we're running out of time here. So yeah, so real quick, my conclusions. Yeah, those are my observations. Yeah, so comparing to yourself and to others, that orients us. So it's good to do it. Comparing to your budget also orients you. See what your plans are. Do that ideally. Quantify your contribution margins per procedure code to the extent you don't have to do it all at once. Like, take a few of them and just say, how long is this taking? What's your target for the tech, the scribe, and yourself to do that procedure? And just start with one of them and just do it. And then basically keep up the good work as ODs. So yeah, it's a pleasure. So like I said, we'll send this Excel sheet. So that's it. Over to you, Dr.
Thank you. Thank you, Brad. It was a lot. We have a few questions, and I'll get to them in a second. Most of them are, where do I get a copy of the Excel spreadsheets? Can I get a copy of the presentation. I want to continue this next time, and I asked Brad to do this in two sessions because, like you, I became a little overwhelmed when Brad was presenting it and we were working together on it. So we're going to do this again next month on March 26th. I think it's a Tuesday, same time. In the AAOMC, what we're trying to do is trying to establish a library of resources for our members. And I think this is extremely valuable. If you have ideas as far as marketing and other ideas, I welcome to look at them. So just jot this date down and we'll expand on it. I think the focus at that webinar we decided is how do you evaluate your practice? Brad was talking about how we hired them as a special project because our practice is approaching 40 years and we don't want to sell it. The original partners are happy. We want to continue working it, but we realize we cannot devote the amount of energy we did maybe 20 years ago. So Brad helped us assess our practice. What is the value? And how do we evaluate that practice without killing the new owners? So we could talk about that, how do practices evaluate their practice, whether to sell it or to stay on and bring an associate. So that'll be March 26th. Brad, if you can go to the next slide. I really want to make a note of thanking Woolman Optical. They're the first sponsor of our webinars. It's unrestricted, granted, they're supporting education, and we can't thank them enough. And if you could advance a slide, one of the advantages I took, I actually approached them when we did the Stellist webinar a few months ago. And they are an SLR lab, and I took advantage of their consultation. And to be honest with you, again, they don't offer me any discounts other than sponsoring this webinar. My staff who met with them, who already were trained on Stellus, met with one of their educational directors. It was Kelly Cohensberg, and they were very impressed with the knowledge they provided. So they provided a QR code here for a complimentary lens and lab evaluation. They're a huge lab. They sponsored 6 of these, and I would at least return the favor, at least inquiring to see if their lab can support you as much as they have supported us. So I just wanted to do a shout out and thank Woolman Optical. I also, Brad, if you can, one of the reasons we do these webinars is to expand our membership at the AAOMC. And one of the projects we've been working on feverishly is how to make Vision by Design in October in Cleveland, Ohio, spectacular. Not only for the education, we are going to make it an event because I have to be honest with you, getting us out of our offices, back into CE, back into symposium, back into collaborating with one another has been a chore. You may have heard that Vision Expo is not doing in East, they're just doing in West. It's because ODs and health providers are very comfortable with virtual CE. I promise you, if you come to Vision by Design in October, you'll have a spectacular time amongst the peers, the colleagues, but also the event. This year, it's in Cleveland, Ohio, the home of Rock and Roll Hall of Fame. That will be our theme this year. It's also across the street, literally overseeing Lake Erie and Cleveland Browns Stadium. So this year, it's October 21st to the 24th. Again, Vision by Design 2026. Please mark your calendar. So with that, Brad, why don't we take a few questions? I have 4 of them, and I think we have about 3 minutes. Everybody says, so when are we going to get these spreadsheets? I think, Brad, we discussed you're going to give them to Megan Schoenfelder, our executive director,
Yes.
and she's going to distribute them within the next week or so to attendees. Is that correct?
Yep, that's correct. So I'll have it off to her tomorrow, and then whenever she sends it up, we'll just the whole. Yes.
Yep. And the other question is, how do I get hold of these slides? I guess we could do a PDF, but I want to tell you one of the assets of being an AAOMC member is all our webinars are recorded and then placed in the member portal. So I think these slides may or may not be helpful. So Brad, you'll decide if you want to give it to us on a PDF, but I really think slowing things down stopping them and really looking at the sample P&L statement. I got a few clinical pearls, or actually financial pearls, that I'm going to be back to my practice. You can see Brad said yes. So as long as you supply Megan Schoenfelder, the executive director, she'll distribute these PDF as well as these worksheets that you're working on. Is that correct, Brad?
Yep, absolutely correct.
And the last thing is, I'm not sure if this has been asked, but are you working on an accrual basis or cash basis? And it seems like you're on a cash basis, correct?
Basis correct. Yes.
All right, very good. So we finished on time. If you have further questions, you can email it to us, and Brad will be kind enough to answer them at his own speed. And I'll see you next month. Everyone that attended tonight, I just want to thank you. I want to thank Woolman Optical, but Brad, I want to thank you because I know how much effort you put into this presentation. I think we met 3 times just to make sure that you felt the content was good so attendees can benefit from it. So I want to thank you especially.
It's a pleasure. Thank you very much.
All right, everyone. Have a great night, great year, and we'll see you next month.